Thank you, Kanaz, and good afternoon to all of you. Uh, Again, thank you all for giving us an opportunity to present on this exciting opportunity, which is of growing consumption in India. But before I talk about the consumption, let me firstly show you a photo. And if you can see the photo on the right hand side, this photo is of Apple opening their first official store in India. You would have seen the similar photo in various social media or news channel. However, we believe that though it was a widely covered event, the significance of this event is underappreciated. And the reason I'm saying that, if we take the example of, say, China, Apple opened their first official store in China in FY09, and since then, its revenue in China has grown by 25 times. We don't really know how the Apple's revenue in India is going to play out over, say, next 10 to 15 years. But the fact that Apple has been selling their products in India for last almost 10, 15 years, but they have decided to open their store now, indicates that they see the similar potential in India. Now, why I am saying that is what we have seen that in various countries, once a particular country crosses a GDP per capita of $2,000, there is an acceleration in the income growth as well as the consumption. Typically, what we have observed that their income grows by almost 4x, and their various consumption categories grow by somewhere between 3 to 7x. And this is something which we have observed at various time periods. This has been played out in US in, say, 1950s and 60s, in Germany in, say, 1950s, 60s and 70s, in Japan between 70s and 80s, in South Korea between 80s and 90s, and most recently in China between, say, 2006 and 2016. India has crossed this inflection point in 2019. And if we compare current India versus, say, China of 2006, when China crossed this inflection point, there is a lot of similarities. And similarities doesn't end just at a GDP per capita. If you look at the numbers of cars being sold, if you take the data point of air passenger travel, there are so many similarities between the two countries. And what we have already seen in China, that post crossing that mark in 2016, they have kind of seen the J curve kind of growth in income as well as consumption. And we believe that similar pattern is expected to play out for India also. And reason we are confident of this playing out in India is the demographics. If we look at currently, there are around 95 million households in India which has an income of 5 lakh and above. However, we expect that this number is expected to double in the coming 10 years. Not only that, we will see a much higher growth in a higher income category, say elite, which is a 20 lakh plus income group. And this has also been already seen in, say, last 3-4 years. If we look at, say, income tax data, the number of tax filers in 10 lakh and above category income group, they have grown by almost 50% plus, versus the number of tax filers in 10 lakh and below category, they have grown in the single digit. So going forward, we expect that there will be a significant appreciation in the income as well. And this is something which will be driven by significant population changes. India will add a very large number of people to the working population. In fact, India will add almost 22% of the world working population by 2031. And currently, India is one of the youngest population in the world. And even by 2030, the median age of India would be around 31 years. And this is almost 10 years younger than, say, China or USA. And another interesting point over here is that if we look at the mix of the population, say, by 2030, almost 3/4 of the population will be of newer generation. And these would be millennials and Gen Z. These are the people who were born between, say, 1985 and 2005. And one thing which we have observed that the newer generation tend to spend a lot more on consumption than the older generation. And we will explain a bit more on this in the coming slides. Another thing, another aspect which will fuel the consumption growth will be the easier access to credit. If we take the example of say 10 years back or 15 years back, if we wanted to take a loan, we have to provide some physical collateral, and sanctioning of loan used to take days, if not months. This has changed very drastically in last 5-7 years. Now we can get the loan based on our credit score. So information collateral has replaced the physical collateral. And secondly, we can go to any physical store or any online store and get the loan within minutes, and hence we can buy the stuff on credit. And this has been reflected in the credit card spend, which has grown almost by 12x in last 10 years. And this is also in a recent time is reflected in the personal loan growth, where small ticket personal loans, say less than 1 lakh rupees personal loan, their volume share has increased from almost 35% in FY18 to around 85% in FY22. So we believe that easier access to credit will act as a second source of money to be spent on the consumption going forward. And this will supplement the income growth, which is already happening. Another thing which we have noticed is that as our income grows, the spend on the essential items or basic items does not grow in the similar proportion, whereas spend on the discretionary items grow disproportionately. And this is something which we have observed globally and as well as in India also. If you see the bottom right-hand chart, this chart reflects the CPI weight of non-food items, which are largely discretionary items. And as the country's GDP per capita is increasing, the weight of the non-food items in CPI is also increasing. In India also, we have seen the similar pattern playing out. If we look at in 1992, almost 60% of the average household spend used to be on the basic essentials. That has now reduced to 40%. But we believe that this is still a very large number, and going forward, this is expected to come down even further. And there would be far greater growth in the discretionary spend. Just to give you an overall context, India is expected to become around $8 trillion economy by 2032. This implies around 10% CAGR return in the nominal GDP. The overall consumption is also expected to grow at a similar pace. However, say non-grocery retail, which is largely the discretionary retail or discretionary spend, that is expected to grow at a much higher rate. This will be almost 2x of the grocery retail growth, and also it will be almost 2x of the growth which this category has witnessed in the previous 10 years. So we will definitely see a much sharper growth, much higher growth in the discretionary consumption as the overall GDP or overall income increases. What we have also seen that there is, as our economies grows, and over a period of time, because of the technological evolution which is also happening, there has been a significant change in the spending pattern which has happened. Again, if we take example, if we go back by 10 or 15 years, if somebody wanted to buy some apparel, they could have bought some branded products, but the number of brands itself was very limited. And consumer at that point of time was even content with buying some unbranded stuff. If we take example of say personal grooming category, there were very, very few items in the personal grooming category. This has now completely changed in last 5-7 years. Now there is so many options which are available in each of the category. And secondly, what we have also observed that the new age consumer, that they really want to upgrade their lifestyle. They want to look good in their own social media circle, and hence they are not shying away in spending for things they want. And this is something which we believe is continue to happen. And another thing which has actually fueled this transition is the evolution of technology, specifically the smartphone. If we again take example, say about 10 years back, if we wanted to do any shopping, we have to plan our shopping perhaps over the weekend and physically have to go to a store. And what we could have bought was limited to items which are available in that particular store. That has now completely changed. we can now shop at any point of time through comfort of our home. We can shop at say 9 o'clock at the comfort of our home and get the stuff delivered the very next day. And this has led to people buying everything at any point of time at any place. And these changes had led to expansion of a lot of categories of consumption, and also a lot of new categories of consumption have also come up. Again, if we take an example of say smartphone, previously about say 10 years back or 15 years back, we used to use feature phone where the battery used to last for multiple days. Now, with the smartphone, battery barely lasts for a single day. Hence, we end up with a multiple charger, say one at home and one at our workplace. We also end up buying, say, power bank so that we can charge our phone on the go. So power bank as a category was not there at all. It was not there, say, 7 years back. This has emerged as a totally new category and it has become a very large category. So is the case with, say, OTT apps. Previously, we used to watch TV only through, say, cable TV or satellite TV only at our home. Now we can watch TV or consume any media on our phone at any point of time we want. So there has been a massive expansion in various categories. This is again which is fueling the consumption growth. So far what we have talked about, that there are three main enablers of the consumption growth in India. One is the growth in the income, which we expect to grow at a significantly higher pace than what it was in the say previous 10 years. Second is the easier access to credit, where credit or loan will act as a second source of money to fund the consumption. And third is the behavior change, where the newer generation is spending a lot more on consumption compared to the previous generation. And there is a lot more avenues to consume also compared to what it used to be the case, say, about 10 years back. Now, what we have, after looking at the expected growth in the consumption, what we have realized that there are certain areas or certain drivers which can lead to certain categories of consumption growing at an even faster pace. One such opportunity is of penetration. If we take an example of, say, AC, AC penetration in India is at around 6% versus, say, in Malaysia at around 30% and in China at around 50%. If we take example of, say, refrigerator, penetration of refrigerator in India is around 35% versus 90% plus in most other countries. So effectively, you will find a refrigerator in most other developing countries in every household, where in India, you will only have 1 out of 3 households with a refrigerator. On the right-hand side, we have also shown various services category like, say, hotel rooms or hospital bed or airline seats or in life insurance, where the penetration of India is far lower than other emerging and other developed countries. And hence, there is a significant room for growth of these particular categories. Again, if we look at the category which is well penetrated, say if we take example of television, which has an overall penetration of around 60% in India, there are still states or districts where it is significantly under-penetrated. If you look at, say, left-hand chart or left-hand India's map, you will see that penetration of television is in, say, state like, say, Uttar Pradesh or Bihar is significantly lower than the rest of the country. And this is mainly because the various states has a very different per capita level. If there are certain states which has a per capita income much higher than the national average, and also there are certain states which has a per capita income much lower than the national average. UP and Bihar again has a much lower per capita income compared to the national average, and that is where even for a well-penetrated category, they have a significant under-penetration. But this is also an opportunity that even for those categories which is reasonably penetrated, there is a massive growth opportunity in some of these states. And hence we believe that some of these categories can continue to grow at a much faster pace than the overall consumption in India for the coming decades or so. Second such opportunity is shift of trade from unorganized to organized. Now, this shift was anyway happening gradually over a period of time. However, some of the recent reforms by the government of India has accelerated this shift. One such reform is the introduction of GST. Another is, say, e-way bill. And even there are some certain sector-specific reforms. So if we take an example of, say, real estate industry, government introduced RERA bill a few years back. And before the introduction of RERA bill, if we look at the share of, say, top 10 organized developer in major cities, their market share used to be, say, around 10 to 15%. But post the introduction of RERA bill, their market share has increased to somewhere between 30 to 70%. If we take an example of, say, jewelry, the share of organized player in the jewelry used to be, say, just 5% in 2000, but that has increased to around 33% currently. And still on the left-hand side, you can see there are various categories where the share of organized retailers or organized players is still very low, somewhere between 15 to 30%. And hence, there's a significant room for these players to keep gaining market share from unorganized players and hence keep growing at a faster pace. A third such opportunity is of premiumization. Due to the behavior change, which I have talked about earlier, and also due to the evolution of technology, there has been a clear move towards the premiumization. But these are not the only things which are driving premiumization. In some of the categories, even some of the regulatory changes is also leading to move towards the premiumization. If we look at, just to give you an example, if you look at the AC as a category, India has an Energy Star rating, and that rating or that norms has been continuously being tightened by the government over a period of time. And as a result, the AC industry is gradually moving from fixed speed AC to the inverter AC. Again, if we look at the evolution of a technology, previously we all used to drive the manual gear car. Now we all want to have an automatic gear car. Previously, if we only used to have some basic music system in our car. Now we all want to have a infotainment system which is internet connected with the Apple CarPlay and Android Auto. So as our income grows, we really want to consume better products, more quality products and premium products. And this is something, again, if we give you some data point, if we take the biscuit as a category, the share of cookies within the biscuit category used to be just 18% in 2009. That has increased to around 35% currently. Again, if we take an example of, say, two-wheelers or scooter as a category, if we look at the premium category, say like 250cc plus bikes, they used to be just 2% of the market in 2014. That has increased to around 8% currently. But this is still a very low number. Recently, Hero has tied up with Harley Davidson and Bajaj has tied up with Triumph. And they are launching a lot of new bike in these categories. And hence, there would be a significant growth in the premium bike category. So this is something, again, is a theme where in some of the categories, there would be a premium category will keep gaining market share. And typically what we have seen, the price point of these products is much significantly higher than the normal product. And hence, there would be far greater growth in some of these categories compared to rest of the overall consumption growth. Fourth such theme is of digitization. Now, UPI has become the new cash of the country. And people are using UPI to pay for a very small ticket item. And on the left-hand side, on the tweet, we have shown that people are using UPI to buy a matchbox of 2 rupees also. And this has been reflected in the digital transaction. So as a digital transaction, as a percentage of GDP used to be just 4.5% in FY16, that has now increased to around 75%. But however, the massive increase in the digital payment has yet to be reflected in online shopping or e-commerce trade. Just to again give you an overall context, India has a population of around 1.4 billion, And out of that, roughly around 55 to 60% of the population has the internet access, but only 10 to 15% of the population actually do online shopping. And again, if we look at the mix of people who are actually doing the online shopping, currently almost 91% of these people are the newer generation, which I talked about, that is millennials and Gen Z. Currently, they are around 42% of the population, but by 2030, they will become almost 3/4 of the population. And this generation is far more comfortable with using the technology compared to the older generation. And hence, online shopping or digital economy in general will become a very, very large portion of the overall economy. And there is a significant growth opportunity in this space. So overall, what I have talked about, there are three main enablers, which is the rise in the income. Second is easier access to credit, which will further fuel the growth in the consumption. And third is the changing behavior, because of which the newer generation is spending a lot more on the consumption than the previous generation. And then I also talked about the four drivers, because of which some of the categories will show a much faster growth in the consumption compared to the overall consumption of India. These four drivers are penetration, shift of trade from unorganized to organized, premiumization, and digitization. So this is something, whatever so far I have talked about, this is what we expect to happen in the future. But what we have done is we have also seen how this category of consumption as a theme has done in the past. So for that, what we have done is we have used NSE India Consumption Index as a proxy to see how that has done compared to, say, broader market or the thematic index. So we have clearly seen that the consumption index has outperformed the broader indices like, say, Nifty 500 or Nifty 50, somewhere between 100 to 200 basis points in various time period, whether we are looking at a 3-year rolling return or 5-year rolling return or 10-year rolling return. And this outperformance has come on back of lower volatility. If we look at the consumption index average volatility in last 10 years, it is around at 16.6%. versus, say, NSE 500, which is at around 18%, Nifty 50 is at around 18.8%, and most other thematic fund is at around 22% plus. And also, if you look at the performance in terms of, say, quartile, NSE Consumption Index has been in first or second quartile in 8 out of last 13 years. So even though there has been some period where this index has performed very poorly, but on an average, it has given a far more consistent return than some of the other broader indices or the other thematic indices. So this definitely indicates that this particular theme can give you a superior risk-adjusted return. And also, this is not a small theme per se. If we look at India's GDP, consumption is almost 60% of India's GDP. And again, if we look at the listed space, it forms roughly around 55% of the listed space companies. So here what we have done is we have looked at all the Nifty 500 companies and seen which company can be formed part of this particular theme. And we have realized that there are around 257 companies, which roughly is around 55% of the NSE 500 index, which can be formed part of the consumption theme. And this theme is there across the sector and across market caps categories. So this is again not a very narrow theme, unlike some of the other sector indices. This is a pretty broad category, and hence we believe that this should be part of every investor portfolio. However, one thing which has happened is that market has rallied by around 15% in last 4 months or so, and hence some of the questions which we keep coming across is whether it is a good time to invest right now, or one should wait for some more correction. If we again, I would like to give you some context that before this rally in the last 4 months or so, there was a period of almost 12 to 14 months where market was moving in sideways. if we take an example of say Nifty 50, it was moving broadly in the range of 16,000 to 18,000. And hence, if we take a more broader or more slightly longer picture, if we take a look at say 1.5 year period, then market has largely moved in line with the earnings growth. It has definitely moved slightly higher than the earnings growth, and because of which, if you look at the valuation is currently at around say half to one standard deviation away from the historical average. However, this range is within the normal range or normal volatility, which is always be there in the market. Market are volatile; it keeps moving slightly higher or lower than the historical average, and we believe that this is within the normal historical range. And also, why we are not that much bothered is if we look at the earnings growth. We expect that the earnings growth for next 2 to 3 years would be in mid to high teens if we take a look at the Nifty 50 index. So as long as the corporate earnings growth remains strong, we should not be too much concerned on the market valuation. And the reason we are confident of this earnings growth coming in next 2 years is mainly if we look at the most high frequency data. These are the data which gets reported on a monthly basis. Most of them are showing an increasing trend. Though there has been a volatility on a month-to-month basis, but the trend is something which is increasing, and most of this data point has now reached a level which is higher than the pre-COVID level. Another main concern which was there, say about 6 months back or 8 months back, was of inflation, which was increasing, and on back of that, RBI was increasing the interest rate. Now, but if we look at currently, over last say 6 months, there has been a significant correction in the global commodity prices, and because of that, the inflation has now corrected a bit, and now it is within the comfort band of RBI, and hence RBI have paused or they are not increasing the interest rate any further. And we don't believe that there is any major risk of further interest rate risk hike in the coming 6 to 12 months. In fact, there is a possibility that maybe by next year, we may start seeing the correction in the interest rate. I would also like to highlight that despite such a sharp increase in the interest rate over say last 8 to 10 months, currently the interest rate is still below the historical average. If you look at say bottom middle chart, this is the chart of home loan interest across last 20 years. And if we take the average of home loan interest rate over last 20 years, the average is around 9%. So just to take an example, in say 2008-9, the home loan interest rate used to be around 12%, and there was a very sharp correction in the interest rate after 2009. And even after the sharp correction, it settled at around 9%. Versus currently, if we look at the current period where after a very sharp increase in the home loan interest rate, still you can get a home loan which is below the 9% interest rate. And hence, if you look at the overall economy, our Indian economy is currently in a very good shape, and we expect that the earnings growth is something which is going to remain strong for the coming 2 years, and hence we are not that much worried about the market. And what we believe that currently is as good a time, time to invest into the market as any. And hence, we are really positive about the overall market, and we are really excited about this particular consumption theme, which is a theme which is going to play out over say next 10, 15 years, and which is expected to show an accelerated growth in consumption. So we all are consumer in our own ways, but this fund gives you an opportunity to also become an investor and trying to generate return out of it. So this is where I will end my presentation, and I will take the questions now. So there has already been some questions which we have invited, and I've received some of those questions. So let me just take those questions and answer. Try to answer those questions. So first such question is, will we be taking any exposure to the foreign equities? And if yes, how much of the portfolio will be those, how much percentage of the portfolio will be those foreign equities. So here I would say that foreign equity, what we are trying to play in this particular fund is mostly trying to capture the India growth story, or India's growth story in the consumption sector. And hence, we will largely focus on the companies which are trying to capture the growth of consumption in India. And hence, accordingly, at this point of time, we will largely be concentrated or largely be looking at companies which are listed in India only. So at this point of time, we are not looking to take any exposure to the foreign equities. The second question is that what are the key sectors that are that we are expected to become part of our portfolio besides, say, FMCG and consumer durable sector? So yeah, FMCG and consumer durable are two sectors which are definitely are part of the become an essential core part of the consumption sector. But apart from that, there are so many other sectors which are part of the consumption story. And here you can see that there are so many sectors like, say, healthcare, real estate, textile, auto. All these sectors are there, which are drivers of consumption. And some of these, as I highlighted, that some of these sectors have a significant opportunity on penetration or trade moving from unorganized to organized. And hence, these are very exciting sectors to be in for the coming 10 to 15 years. And we will be looking at some of these sectors also. So again, as I highlighted earlier, that this theme is a pretty broad theme. There are so many sectors which get covered in this particular theme, and we will be using all these sectors while constructing the portfolio. So it will not be focused on one or two particular sector. It will be a pretty broad-based fund for us. The third question is that FMCG stocks has always been traded at a higher valuation. How would you go about picking stocks in this particular sector? So yeah, this is again a very right observation that FMCG sector is generally has been traded at a premium valuation than the broader market. But that is also coming from because of the fact that FMCG company in general are much higher quality company than some of the other companies in the overall broader market. Most of these companies have a very high return on capital. Most of these companies have a very good brand and loyal customers, and hence their revenues and their earnings does not have that high volatility which we see with some of the other companies in other sectors. And also the quality of balance sheet. Most of these companies are debt free. Most of these companies have a very low amount of working capital. So overall quality of companies, overall quality of management is superior to some of the other segment or other sectors. And hence these companies generally tend to trade at a premium valuation. Another important point over here is that when we look at the valuation, we essentially look at the valuation of a individual company based on its peer group as well as based on its historical valuation. And what we have already seen that and what we have already said that these companies has historically been traded at a premium valuation. So this is something which is not new. Even if you just to give you an example, if we take a look at, say, NSE consumption index, the PE of that particular index is somewhere around 35 times 12 months forward earnings compared to, say, Nifty 50, which typically trades at around 17 to 18 times. So this index, that is NSE consumption index, has always traded at a premium to the historical, to the broader index, which is Nifty 50 index. However, as I highlighted earlier, the broader market currently is trading somewhere between half to one standard deviation away from the historical average. Even this index is also trading somewhere between half to one standard deviation away from the historical average. So this valuation, again, compared to the historical average, is in line with the broader market. So they are, though they trade at a premium valuation, but this is in line with their overall historical average. And this is something which is also driven by the fact that these companies are of much better quality compared to some of the other companies. And hence we are pretty comfortable owning some of these names. And again, we will own this company based on, say, outlook of this particular stock going forward, the growth prospect of these particular companies. And hence we will take all the due diligence which is there by selecting the individual company. Another question is that thematic funds are known for high volatility. How this fund will be any different? Okay. So if we, again, what I have highlighted over here when I showed the volatility chart, that the observation is right that the most other thematic funds tend to have a much higher volatility. And if you look at the average volatility of the other thematic funds or other thematic indexes, that is around 22%. But NSE Consumption Index has a far lower volatility. It is not only lower compared to the other thematic indices, it is even lower than the broader market. And again, that is coming from the fact that some of these companies are much higher quality companies, and there is much lower volatility in those underlying companies, which get reflected in the overall theme or overall index volatility. And hence, we believe that the overall index or overall volatility of this particular theme will be lower compared to the, say, broader market. The next question is, why should we consider investing in an active fund NFO when passive funds are more cost effective? Yes. So generally, passive funds has a much lower expense ratio, and hence they are more cost effective. However, at the same time, we are a big believer of the active fund management. And that is coming from the fact that the way the passive funds are constructed, they are typically the companies in the most of the indices are selected based on the market cap criteria or free float market cap. So only they just get selected based on the top 10, top 30 or top 50 market cap, free float market cap companies, and that largely become part of the index. That methodology has some merit, but that is a very narrow way to look at the market or the overall prospect of the company. There are so many other important factors which get missed out when one is looking at the portfolio in this way. And hence, we believe that active fund management has a very important role in India. And this is something which is continuing to happen. And another important point I would also highlight that if we look at the index, particularly for the thematic index, they tend to be very, very concentrated. If we look at, say, top 10 companies in the index, their weight is around 65% in the index. Also, there are certain sectors which are dominating in terms of weight. Say, FMCG has around 37% sector. Again, auto and consumer durable has another 20 and 16.5% sector. While some of the other sectors, like, say, real estate or textile, are underrepresented in the index. And hence, we believe that we can be far more diversified in terms of sectors, where we can take a much higher exposure on some of the sectors where we are far more positive. And hence, we believe that the weight in the index is not justified, and they deserve a much higher weight in the portfolio. Hence, we can take those active bets or active position in our portfolio. And hence, we believe that active management can give you a superior return compared to a passive index. Another question is that of late, infrastructure and capital goods related stock has done well. Should we consider infrastructure fund or the consumption fund? Again, this is an interesting question, and that is correct that if we look at the last 6 months, the infrastructure as a category has done really well. And again, we have, as a theme, we are very positive on the capex revival story, which is happening in India. And again, we believe that is also a reasonably long-term theme which is going to play out over the next 3 to 5 years. The main difference between, say, capex theme or infrastructure theme versus a consumption theme is that infrastructure theme has a much higher external dependency. If we the capex cycle is lot more dependent on the government spending, and we have historically seen that there are years the government spend really high amount on the various infrastructure sectors. However, there are also years when the government does not spend as much as they should have, and hence the growth of those companies take a hit, and in those years those companies tend to underperform. If we look at the consumption theme, again, this is largely a bottom-up theme where the growth of these companies is dependent upon the income growth which we expect to happen, and hence this is a far more gradual or more consistent theme which is there. And again, we are not saying that the consumption theme is not going to underperform in any of the year. There would be a year where it may underperform, but just relative to the between these two themes, we expect that the consumption theme should give you a far more consistent performance than the capital goods or infrastructure theme. And hence, we believe that though both the themes are important, but between the two themes, maybe consumption theme can give you a superior risk-adjusted return. And hence, you should really consider this particular theme. The next question is how we will allocate between, say, large cap, mid cap, and small cap. Again, if we look at the index is highly skewed towards the large cap, and this is particularly true for any index when we look at whether it is a diversified index or whether it is a thematic index. However, when we are constructing our portfolio, we will be far more diversified even in terms of market cap. As you see that in this slide, there are roughly 257 companies out of 500 companies which can be part of this particular theme. But out of 257 companies, or roughly 60 odd companies is only in the large cap, and there are around 200 companies which are in the mid and small cap. And hence, there are far greater number of companies which are there in mid and small cap compared to large cap. And there is a significant amount of opportunities also which are there in that particular space. And we have a very large in-house research where we cover a lot of these companies, and we may not necessarily rely on the external research. And there are a lot of companies where external research is not available, but we have our own in-house research, and based on that, we can take exposure to some of these companies. And hence, we believe that we can really play this to our advantage, and hence we will have a far more diversified approach towards the market cap allocation compared to, say, index, and we will have a reasonably good allocation towards each of these three categories of market cap. Next question is this a good time to invest in HSBC consumption fund? And if yes, what makes this consumption fund different from other consumption themes in the market? Okay, so as I highlighted that currently, though there is some worry with respect to valuation, however, given that there is expected to be a very strong corporate earnings growth which will be there, we are not that much worried about the market. And generally, the Indian economy is doing reasonably well, where they have been most economic data points are showing that we are growing at a reasonably good, healthy pace. And at the same time, I also highlighted that at an overall corporate level, we expect that for the, say, Nifty 50 companies, we expect that the earnings is expected to grow at, say, somewhere between 15 to 17-18% over the next 2 to 3 years. But when we look at, say, consumption index companies, those companies are expected to grow at an even higher pace. They are expected to grow at, say, 20% plus pace over the next couple of years. So this is again one sector where we believe that growth is expected to be slightly higher, and hence this would be a very good place to be in the market at this point of time. How we are different from the other fund is something I will not really comment on the other fund, but what I will say is what are our advantage. And I also touch upon that a bit previously, that we have a very large in-house research. We have around 7 to 8 analysts which are tracking various sectors, and they are covering a very large number of companies. And given the fact that there is a very large opportunity in mid and small cap, we can take exposure to some of these companies, which may some of the other fund house may not be able to do if they have a smaller research team. And that is something which will really, we believe that it will play to our advantage. And this is something which has already been reflected in our other fund, where we have taken significant exposure to some of these segments, and that has actually resulted into generating alpha in those funds. So that is where we believe that given our large in-house research team, we will really be able to capitalize the mid and small cap space, and we will be able to generate the alpha in this particular space. The next question is, I am a first-time investor in the mutual fund industry. Do you think that I can commence my investment journey with the consumption theme? Yes. So this is something, what we really suggest that anybody can start their investment journey into the equities at any point of time. There is no age limit that one should start early or one should start late. One can start as soon as you have the capital and the risk appetite to invest into the market. And consumption theme would be a very good starting point, given the fact that, as I highlighted earlier, that we expect that this particular theme to have a lower volatility compared to the other market, other thematic fund, or even the broader market. And hence, we believe that this fund should be an ideal fund for every investor portfolio, and hence one can definitely consider this fund to start their investment journey. The last question which I will take is what period should I remain invested in this particular fund? Okay. So again, I will not be able to give any specific numbers per se, but as I highlighted earlier, that we expect that the consumption to grow at a very healthy pace in the next coming 10 to 15 years. And what we have seen that this has been played out in various countries, but after the very healthy growth for say around 10 to 15 years, there is some bit of a slowdown also which has happened, mainly because of the high base. And hence, India currently is in a very sweet spot where we expect that there would be a consistent or high growth in the consumption for next 10 to 15 years. And hence, one should not look at this particular theme only for say 1 or 2 years. One should keep a very long period of horizon of around 10 or years or so to invest into that particular theme, this particular theme. Because we really believe that over a long period of time, this particular theme can really generate a superior return. And this is something, again, which we have highlighted, that if you look at the 10-year rolling return of this particular theme, that has really generated a large alpha over, say, Nifty 50 or Nifty 500 index. And hence, we believe that this is a long-term story for India, and you should also consider this theme from a long-term perspective. So these are the main questions which was there, and hence I will end over here. Thank you all for being here and giving us an opportunity to present this exciting idea. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.